Good evening, friends. Welcome to special subscriber webinar on modified your portfolio. Uh, I hope all of you have got the report that was due to you on 31st of March. If anyone of you have not yet received our report, please let us know uh, so that we can resend it to you again. Or if we have for some reason by mistake, if we have missed out, then we like to apologize for it, but we like you to have that report at all costs. So please let us know so that we can send it to you. Secondly, if during the course of the presentation, if you have any query, please feel free to answer. I would try and take those queries during the course of the presentation. If I miss out those queries, I would take them later on. Uh, those of you who have got the chance to go through a report, this presentation would play a very important role in that it would let you understand our expectation. It would let you understand from where we are coming in, what is the core assumption that we are building in towards and the outlook and the companies that we have mentioned in the report. Now with this, I would like to start. Now, when we started sometime in Jan of 2014, as to what were the most likely things that would impact the market going forward, we had placed 4 points. Uh, First was Indian general elections. We have already seen the impact of this going forward. Second, US pace of recovery in US has continued to accelerate. It has been much better. We believe that going forward, uh, the Fed may have to revisit its decision of a calibrated, slow approach of reducing the amount of tapering that it is doing. It may probably have to rethink its decision of reaching a normal Fed fund rate of 4%. Right now, if you look at it, federal fund rate is close to 0 to 0.25%. We believe that this, if the US economy continues to grow at a sustainable pace, uh, Fed would not have the leverage of room to have just to continue to have such a loose monetary policy. Otherwise, they would end up stroking inflation fears across the world, and because of that, they may have to revisit their original idea of probably a small marginal rate increase at the end of 2015, going and reaching towards 4% somewhere close to 2018. We believe it may actually be much more faster than most of us expect as of now, because uh, the inflation may continue to become a much more higher risk globally if we continue to keep a very low expansionary policy. Second, China. Uh, we do not foresee a very hard landing for a simple reason that post the new leadership coming in on China, they have been very cautious about the problems in the Chinese economy, which has become structurally too dependent on how much investment-led growth is going to push the economic growth. Now, as there is a small concept in economics called as diminishing returns. What it means is, if you keep on doing the same activity, then the benefit that you realize from every additional amount of effort that you put keeps on decreasing. And if taken to an extreme, it can have a negative impact on your output also. Now, something similar has been seen in China because of the huge investment-led growth. We are seeing cases wherein an investment like a city has been built or an airport has been built, but it has not been used to its optimum requirement. Now, China is now trying to recalibrate its economy towards a consumption-led story, similar to like India, rather than an investment-led story. Now, this shift may cause some amount of disruptions that may create additional opportunities if and when they happen. We'll be very glad to come up with those kind of contrarian buy stories to you. But however, this shift may result in two things happening. One, Chinese growth may come down to a much more sustainable base, like 4 to 5% rates, before it starts in a plateauing and as the Chinese economy grows. Right? The fourth path, uh, while yeah, we are now seeing stability return back to major parts of Europe, but we continue to think that the risk remains because the core problem of a unsustainable welfare economy uh, remains a questionable question till when you see that the economic growth in many of these uh, core economies of the Europe and are seeing a slowdown, largely driven by the fact that the job growth has been very low, uh, by the fact that the global demand for the capital goods kind of export or engineered product that they see has been very low. So we believe that Europe, while it is seeing we are seeing stability return back into say Greece or Italy and even to some extent to France, but one needs to be very cautious with respect to that. Now, our key theme for the month of March was to the fact that this general election is going to be very important in the sense that after a decade there is a strong likelihood of a shift in the way the government would be going ahead with its policy measures. This would we do think that this would be brought about largely driven by the fact that uh, we Indians may see a shift in the political party that may end up forming the government. Second, if you look at the India story as such, many aspects have of or themes that we are presenting in this presentation are places wherein we believe at some level, even if in a different party comes in, a certain amount of reforms or policy decisions will have to be taken, because at one way or the other way these themes are becoming constrained to the Indian growth story. So either we need to revisit the hypothesis that India can continue to get a 5% plus kind of a growth rate and may actually end up going forward may taper down to an 2.5 to 3.5% as growth rate that was derisively named as Hindu growth rate. Or if we continue to believe that yes, India has a potential of 5%, then these are the key constraint points where some level of policy decisions have to be taken place, even if we see any kind of political formation. Now, if we see as the opinion polls are now predicting that kind of thing to play in, then things may change much more drastically. But if things work out as they have been till now, then the opportunities will be a bit different. For investment, but some level, some of these opportunities that we have suggested in the report will still work out, but probably not necessarily to that extent. Uh, Now, let's recap what the polls have been showing. Now, generally, most of the polls have been showing that the BJP-led NDA government can garner anywhere close to 210 to 230 seats, while the Congress may see one of its worst performance, which may lead UPA to gain just close to 110 to 130 seats. Now, there are few caveats that needs to be added and understood over here very clearly. Generally, it is seen that opinion polls have tended to overestimate the performance of BJP, largely for a fact driven by the fact that BJP is a much more urban party, and it has much more and a strong support in the urban space rather than in a rural space. And somehow the opinion polls that are conducted, they tend to have a bias of taking samples largely from urban India, because these places are much more accessible. People in these places are much more accessible, because of which it is possible that the opinion polls may be overstating the case of BJP and understating the case of Congress to certain extent. So this caveat needs to be kept in mind before expecting the opinion polls to give us quite a good estimate of how things may play out into future. If, however, let's assume that the opinion polls are largely on the ball with respect to what is likely to happen, then we can start expecting a strong policy reset to happen at the economic level, and this can create a huge amount of opportunities. I will get into this, what are the likely policy resets that can happen and what kind of opportunities this will end up creating as we start entering into discussion of one each and every sector that we have tried and kept in this presentation. If there is any other sector that I have missed out, please let me know through the chat window. I will gladly take those also and let you know our expectation about those particular sectors also. Now, as I stated, there are some big risks to the poll assumptions that have been made. One, a general assumption has been made that there is a strong anti-Congress sentiment, and somehow this will convert into an anti-vote towards Congress, and non-Congress aligned parties would be the likely beneficiaries. This also leads people to some of the people to some of the pollsters to conclude that one of the key beneficiaries of this anti-Congress kind of a vote is going to be to BJP. But if you look at the way the most of the seat projections have been done by the opinion polls, the key factor that you are saying is that it is not as if the BJP spread across India is increasing. Largely, what we are seeing is that in places where we are seeing a bipolar and politics in which there is a direct competition between BJP and Congress, we are seeing these states being swept by BJP. What we mean to say this is that in the core states where BJP has been existing for quite a long time, the pollsters are projecting a possibility that uh, Congress may see a rout, and the hit ratio of BJP may actually be very high. So if BJP fights for, let's say, 200, 300 seats in its core areas, it can see a very high conversion ratio from the seats that it is fighting and the seats it ends up winning. Uh, Third big assumption that is made is other parties that include both the regional parties like BSP, SP, as well as certain new parties like AAP. They are somehow failing to capitalize on anti-Congress. They have created some of them have created a strong buzz, but that buzz is not necessarily translating into votes or from votes to seats. uh, uh, and one of the big factors that some pollsters are making, I don't say every pollster is making, but those who are inherently assuming that Congress may go to say seats of a 70 to 80 kind of a number, an inherent assumption is also made that Congress is probably now becoming organizationally weak. One of the big things that Congress has as a competitive advantage, if I can use a management term, compared to every other party in India, is that the organizational spread of Congress as always has been huge. It is the only party that exists in India that has presence from Jammu and Kashmir in the north to Kanyakumari in the south, from Gujarat in the west to Assam and Arunachal Pradesh in the east. So the spread of Congress has always been phenomenal, though it has seen it become very weak in places like Tamil Nadu, now even Andhra Pradesh, and again to some extent in Orissa. But it is a party that has had a phenomenal organizational spread. That is why, unlike most of the parties, Congress performance has evolved from nearly each and every state. So if you look at 2009, the big states that contributed much to the uh, Congress performance were Andhra Pradesh and Maharashtra, and not necessarily so much as UP. Typically, it has been hypothesized that if a party wants to capture the central stage, then it has to go through Lucknow. But uh, over last one decade, this has not necessarily been true for Congress, and this is largely driven by the fact that Congress has a very much widespread. But if we are now to believe that the pollsters are now estimating that Congress may get to 60 or 70 seats, we are effectively saying that Congress is running a risk of seeing it become organizationally weak, which also means then that this market segment that Congress has typically targeted, that is the left liberal segment in India, is up for grabs by any political formation that tends to adopt similar principles like Congress may be diverse from certain ills that suffers a Congress. So that is why it's not surprising that we are seeing a party like Aam Aadmi Party coming up, and if you see, then most of the votes that it is trying to capture are typically the votes that would have gone to Congress. So a big political vote chunk exists for grabs, especially if Congress is weakening. However, we don't think this kind of shift will happen immediately in this election. This is something to be looked out for the next election and would play a very critical role. So, what are the major policy shift that we are expecting? So the major policy shift that we are expecting are that a new government that would come in would be more focused on building investment-led growth. What we mean by investment-led growth is that we would see a huge bump in the way the infrastructure buildup is going to take place, especially in the power sector, especially in the road sector and the urban sectors. Now, if you look at certain aspects of Indian economy, uh, compared to global aspects, if I were to take just one sector for your information, let's look at real estate sector. Now in real estate sector, most in India, you typically get a floor space index of close to 1.5 to 2. Now, if you look at global space, then typically, at least for the large cities globally, it could ranges from anywhere from 5 to 10, or sometimes even above. Now, what it means is that if I were to take a 1 acre of land, I can build a built up space of only 1.5 acre to 2 acres at max. Now this artificially brings a huge amount of deficiency or supply deficiency in between how much is the demand for real estate and how much is the supply. We believe that eventually India will have to move to a very higher level of FSI. Now, it's not just a case of a political reform being brought in that can raise the FSI to a very high level, because this is a state subject and not necessarily a central subject. Second, in order to do that, there are other kinds of infrastructure also, support system also, that one needs to build in. To put a very simplistic case in mind, if we want to go to a very high level floor space index like 10, then basically we need to have very strong firefighting skills, because as of now there are very few cities who are equipped to handle firefights if another fire were to happen in, say, on the 15th floor or 20th floor. That is what effectively a 10 FSI would mean, that we can go to a floor levels of 30 or 50s as such, and very few cities have the ability to cater to that kind of safety. Now, because of this reason, one of the ideas that have been propagated, and this is largely coming up from the way some of the emerging economies in the Eastern Europe area has been evolving, is through building up of strong satellites township. Now, in the initial part of the way US was evolving, many of the cities were actually industrial townships, who later on graduated to becoming big cities. For example, Seattle was largely known to be a airline city. Many of the airline manufacturing companies of the in the time of 1920s to 1950s were coming up in Seattle, and the Seattle emerged as a city largely because of the manufacturing base of an airline industry. Same way, Detroit came up because of the presence of all the three, that is Ford, Chrysler, as well as General Motors. Uh, the point that I'm trying to make is that in a normal course of development of a country, uh, you see more and more cities springing up. That is what actually urbanization means. Somehow Indian policymakers have got a very skewed concept that the urbanization basically means rural India entering into new urban to existing urban space, and that is why much of the action has not been taken by Indian policymakers in seeing to it that our cities do not get crowded. Rather, at some level, we have tried to encourage this migration from rural to urban in existing urban India under the false sense of belief that this is what would be because of lead to an economic growth. While if you look at globally, the major way through which most of the global economies have evolved over long duration has been by allowing uh, tier 2 tier 3 townships to become much more larger than what they were at the start, and allowing that growth to have facilities that would be uh, if not similar, be comparable to what would exist in tier 1 cities. The only exception has been China, and that has been an exception in the initial part. But however, if you now look, that itself is also changing, because China has been more focused on allowing its interior China also to develop at a faster rate, driven by the development that has already happened on the coastal area of China. So we believe that investment-led growth that will lead to tier 2 or tier 3 townships evolve into new urban centers would be something that would be very exciting space for people to invest into, either directly through real estate into these centers, or through proxies, which we would be talking about going forward. The next is manufacturing and agriculture led growth. Now, India is among the few developing economies in which, if you see, we have a skewed performance in between the three pillars of economic growth, that is manufacturing, agriculture, and services. A large part, close to 65 to 70 percentage of our economic growth is contributed by service. Now, one of the reasons that this has been supported by the policymaker has been that. because of the fact that India has very high level of youth who would be looking out for jobs and are coming in over the last 10 years and would continue over next 15-20 years. Now service led growth allows a huge amount of job expansion to happen for same per unit of GDP growth rate. However, this kind of creates a few nuances within the economic model that we are trying to build. One, because it becomes inherently too dependent on services, it economically depends too much on consumption oriented business model. So while China has gone to one extreme of being towards the investment led model, we have gone towards the other extreme of becoming too much of a consumption led model. Now this is extremely good way of doing it when you are trying, you have already reached a development space, you have already exhausted the export potential that could be there from your country. If you look at India, we have not yet exhausted the export potential that we could have had from our country, especially in manufacturing space. We have not exhausted the productivity that we could generate in the agricultural space. Because of this, what we are seeing is that both of these two sectors are lagging over the last 20 years, and services have taken the much of the uh, benefit of another growth. We believe that the new government's focus would be too much, would increase towards manufacturing and agriculture. It would be too naive on our part to assume that the next 5 years can dramatically shift the economic model of a country. It takes time to build a new economic model, but we do believe that over going forward over next 10 to 15 years, a slight shift can be expected. We can, if we see a high productivity led growth in agriculture, we would see agriculture becoming again becoming a dominant factor within the economic model of India. Same way, if we see in a more manufacturing space coming in, then we would see a large economic benefits occurring to India. Now there is a key reason why this is important. Another key reason why it is important, if you would remember, in August of 2013, we had seen an rupee depreciate. Now if India would have had very strong manufacturing presence, this is not something that would have worried us. Why? Because a strong manufacturing presence would be highly correlated to higher level of exports happening in the following periods, and that would have counterbalanced the impact of current account deficit, because export would have brought in much more higher level foreign forex reserves, and we could have kind of grow, come out of the crisis and in a auto mode formation. But however, India continues to have very and a high level of and red tape with respect to how you can put up your manufacturing units, and because of that now we have not seen that kind of activity. So we believe that manufacturing and agriculture led growth would be another the other pillar that we can expect because of this policy shift. Second, banking reforms. Now banking reforms, what do we mean by banking reforms? Now, some of the pillars of the banking reforms are already been put in place by the RBI governor. If you look at the recent statement that he has been making, he has been very consistent in saying that he would like to enter into an auto mode of licensing to the banks, especially if they are coming with very specialized kind of banking services. Uh, what he's trying to see it is that we, going forward over the next 10 years, excuse me, going forward over the next 10 years, one of the key objectives of the policymakers would be to bring in as much of financial inclusion as possible. In this context, we are a bit surprised with the fact that the Ministry of Finance did not clear Indian Post for the banking license, because of which it has got stuck. uh, because Indian Post, among all the other applicants, has could have built a very unique model, because it has one of the widest rural network spread, so even much better than what SBI has today, and that could have ensured a very strong uh, financial inclusion happening over the next 1 decade. We are a bit surprised that a Minister of Finance under the Minister of Finance Chidambaram had not cleared the Indian Post for the banking license. Second part that we mean with banking reform is, if you look at the way Indian growth story has happened over the last 5 years, it has been a huge invest capital capex led boom that has happened. So we have seen you and a banks funding either a telecom spectrum, banks funding either power plant build up, or banks funding infrastructure build up. But if you look at each of these sectors, micro level reforms have not been done, and yet banks have gone ahead and funded them. At many places, if you look at many PSU banks, the risk management strategy remains to very still remains very there is still very good scope for making it better. uh, we believe that they are not yet started following the global best practices. W- Second, we also believe that the interference in their work continues to be very high. This is we believe that given the huge amount of financial asset stress that has been built up within the 20 years. If you remember, in 1995 the Indian banks had gone through similar kind of high level of financial stress built up in their asset. It had not been as high. It was around 20 percentage of, as in gross NPA was close to 20 percentage of their asset size. The current stress has not been as high as it was in 1995, but it's still very very high. And this is not something that most policymakers would like to have, given the experience of 2008, because failure of a large bank can derail the economy. So we believe that PSU-led banks would see a huge level of autonomy and reforms happening space. We believe that RBI is desperate to see to it that this kind of thing takes place. At first level, we see that RBI would like to go for automatic recognition of non-performing assets. RBI would like to go for uh, early warning signals to realize if there is a certain asset class that is becoming stressed, so it can increase the capital and a requirement for that particular sector, and thus manage the risk better in the whole of the banking sector. Third, we also are seeing that at some level, many of the key policy makers who would be defining the policies of the two large parties, that is Congress as well as BJP, are at some level realizing that a bit of excess has happened at this time, and banks need to be supported at this duration, so that they can recover. Otherwise, there is a very strong likelihood of another fact that this situation can go out of control, and we would be at a similar stage as US was in 2008, which would be very very tricky for India to come out of, given the fact that we have led entitlement based, uh, high fiscal deficit based, and a budget over the last 10 years. So the budgetary support room is very very low. So we think that both the policymakers, both on the Congress side as well as BJP side, at some level understand that some level of autonomy and reforms are needed at PSU level. Third is a very important point and is very critical to the fourth, that is the power sector reform. One of the key constraints for power sector to really make a viable business model is an absence of and clarity on the natural resources, whether it is oil and gas or whether it is coal. Now, if you look at the fact that over the last 3 4 years, each of the natural resource sector, whether it is iron ore, whether it is coal, whether it is in a natural gas and oil, or whether it is in a granting new mining licenses for cases like bauxite, each of these kind of cases have at some level or other level got stuck. One of the biggest FDI investment that was ever made in India, that was a $12 billion POSCO's and a steel plant in Orissa. Now it is close to 10 years, and we have not yet seen basic structural activity yet begun. Uh, and the big reason is because India has never consciously focused on developing a comprehensive natural resource and a policies eh, that would be applicable across the board. Now, if you look at some of the countries in Africa, even in countries in Africa, you like Namibia, they tend to have very strong natural resource policies. uh, if you look at even the developed countries like US, they tend to have very strong natural resource policy, which clearly lays out how the resources would be divided in between the government and in between the private operator. It also clearly lays out what are the environmental duties of the operator. uh, and it is closely regulated, the environmental actions are closely regulated by the government, so as to ensure that the activity can be done in a way that it is environmentally less painful for the society as such. Now, at some level, we believe whether you are a developing country or developed country, the cost of natural resource and business is only going to increase as far as it's an as far as it's an activity towards maintaining the environment goes. We believe it will only go and increase. If you are a developed country, it may happen very immediately. If you are a developing country with too much of crony capitalism, it may take time, but it would eventually happen. So getting the clarity on natural resource sector will be very key, because it is important to help the fourth point, that is power sector reforms. Power sector suffers from four levels of problems. One, uh, there is lack of clarity on the land side. There is lack of clarity on the fuel side, that we believe is driven by the lack of understanding of natural resource. Third, there is lack of clarity on the environmental clearance side. Many of the power projects also get have stuck over the non-receiving of an environmental licenses. And fourth, and the critical part, is that many of the power sectors do not have a clear-cut regulatory framework within which they are going to work, and this increases the cost of borrowing for them, because of which we are seeing that one of the big chunks of the NPAs of the banks is through the power sector. So if you look at Punjab National Bank, a very large part of its non-performing assets is emanating from from power sector and based companies, whether it is state electricity boards, or whether we believe it is say capital goods kind of companies, whether it is kind of companies who are in the transmission generating side of the story, or whether those are companies who are in the distribution side of companies. Even in the capital goods, some companies, not necessarily companies like BHEL, but some companies like say Jyoti Structures, they have very high balance sheet and stress, largely built up on the fact that they have not yet got their dues from the state electricity boards. So we believe that these 4 points, that is, I would like to recap: investment, manufacturing, and agriculture-led job growth; banking reforms; third, clarity on the natural resource sector; and fourth, uh, reforms across the whole power sector would be key for any new political party that takes the hot seat after the election, general election of 2014. So let's go through each one of them. Now, power sector, one of the key reasons that we generally have not liked power sector in the past is that each of the power sectors over the last 10 years have been very unattentive towards the huge amount of balance sheet stress they have carried. Now, it was good till the going was good, but the moment things have turned bad, many of the power sector companies, including to some extent, and a company like NTPC, they tend to have very high level of balance sheet stress. Now, it can one can argue that one of the reason that this has happened is because of the low margins and profitability that they have commanded, but it is also driven by the fact because of if you look at the way Indian power sector companies operate, they tend to take huge amount of debt right at the start without considering the problem of the execution risk that may come in while execution of the power. Now, power sectors globally tend to be very regulated, and because they tend to be very regulated, it's very easy for them to have very high level of debt in them. So let me explain this to you. So if you are into a company that has an assured buyer with you, you are also in a business that has assured and a raw material supplier to you, because the cost as well as the amount is assured on both the sides. Your business has relatively low amount of risk, and because your business has low amount of risk, you can theoretically saying go with a high level of debt and low level of equity, thus leverage your position and earn a strong return on equity. Now, this is a very good way of this is a very good corporate finance way of going ahead and doing a business that is a more utility kind of a business. However, one must need to be careful with the fact that one needs to be very careful with respect to fact that uh, this is a good strategy when you have an asset in place, but when you are building an asset, you have multiple risks that are taking place in your business, especially driven by the fact that your project can get prolonged for reasons beyond your control, like you have your environmental license gets cancelled, you could not get the fuel supply linkages on time, so your projects can get delayed or can get cancelled, and you carry a huge execution risk. We believe that at some level many of the power sector companies who did not have experience with these kind of business models uh, are facing this kind of risk as of now. So we do not like this amount of stress that is there in the balance sheet of many of the power sector companies. Yes, there is a point of argumentation that this part is recognized by the market and they have got beaten down, but because of the huge balance sheet stress that we believe are dangerous enough to risk the company's financial future, we would tend to avoid power sector. Now, going as we have said that going forward, power sector reforms will be one of the key, and uh, we believe that getting benefit out of the fact that power sector reforms will happen, it is better to go through the second derivatives of this investment thesis rather than the first derivatives, that is by entering into power sector. And what do we mean by that? We mean that we can rather enter and get the benefit of the power sector reforms by entering into select few capital goods companies. Now, most of these capital goods companies, while they may suffer today from a bit of lower amount of order book than they had seen in the years like 2005 to 2008 kind of year, they may be having lower level of order book, but we believe that once the power sector reforms happen, we can see a very strong likelihood of this order book only increasing. We have already started seeing initial shift towards that direction in some of the capital goods companies, though they are not necessarily directly related to power sector, they are related to the similar kind of thought process, especially if you look at EIL, if you look at some companies like BGR Energy, they are also now starting to get a good amount of order book again. Second, one of the key things that we have observed over in a strong capital goods companies is as strong as well, and especially large capital goods companies, is that even in the worst part of this last 5 years, when traditionally there was not much order to be had by the capital goods companies, some of the companies like Cummins or BHEL or Siemens have tended to have very high level of value creation index. Now, we believe that while this value creation index have been very strong, we believe that this is only going to get better once we start seeing in a very high level of order book, and this is going to help these companies get re-rated in the marketplace, and they may command a much better premium in the marketplace than what they're commanding. And some of these companies like BHL tend to are even today are trading at a very low level of price to equity multiple, of price to book multiple, than what they can trade at if we were to reach back to say 7% kind of growth rate. Another big thing that because of which we like some of these capital goods companies is while they tend to have very high level of working capital days, uh, they have tried at some level to bring down those working capital days. Second, and this has resulted in very strong cash flows coming in into these companies. We believe that these all things are very good reasons for a person to actively look at capital goods companies. And within this, there is one sector that is generally overlooked and which we have tried to highlight it in our report is capital goods companies, but who are not necessarily power dependent companies, but who have a different business model. So these are companies like EIL, Engineers India Limited, who is more dependent on how oil and gas and expansion happens, or even Bharat Electronics Limited, which is more dependent upon how the expansion happens in the armed forces. Now, the case for BEL is a much more simpler one. Over the last 3 to 4 years, because of the high level of fiscal deficit that we have been seeing in the economy in general, uh, the government has cut back into how much capital expense that the armed forces can make, and this has already started to show its negative repercussions. Uh, we believe that there will be a strong correction happening in this behavior of the government within next 24 months, and that would result in a very strong order flow to an BL, increased in margins as well as increased in working capital and a benefit occurring to BL, which has got stretched off late. And BL, if you look at current price levels, it is still attractive because if you see at the company, nearly 75 to 80 percentage of the share price is just at its cash value. So you are paying relatively very low for a company that has a very strong business model, that is a near monopoly kind of a business model. Second, we also believe that government will go for a very strong purchases for armed forces from outside of India, and one of the areas where they would be going for this kind of purchases is going to be in the electronic warfare side of the business, whether it is radars or whether it is in a cases things like drones, or whether it is in a battlefield radars. Uh, and given the government's policy of 30% export offset policy, uh, sorry, it's 30% import offset policy. One of the prime contenders of catering to that space would be Bharat Electronics Limited. So we are very positive towards the future of these kind of specific cases who have very strong business model, very strong niche in that particular segment, and is generally overlooked by the market during the current time. We believe that eventually market will start realizing the strong cash flows and the strong returns that these kind of companies are generating for their shareholders, and will start giving a huge amount of premium to these kind of companies. Before I enter into infrastructure sector, I would like to highlight another sector, which is again in a power sector related. As I stated in the power sector part, the last part, that is we prefer to have a second derivatives rather than the first derivatives. Uh, Most people would think of capital goods sectors as the second derivatives, but many a times we forget that there are again two specialized companies who cater to power sector finance, that is Power Finance Corporation as well as a Rural Electric Corporation, the PFC and REC. Now both of them have very strong names. They have very strong capital adequacy ratios. They have very low NPA levels. They provide very low cost funding to the companies, and because of that we believe that it is in the benefit of these companies to not to default with these two financial institutions. Second, these financial institutions are supported by the tax and benefit that one can derive when they subscribe to the bonds of PFC or REC, and that allows them to raise money at a very low cost. Because of these two reasons, we believe that if one needs to get a benefit out of power sector, then going through select capital goods or select NBFCs like PFC and REC would be much more beneficial rather than entering into power sector where the balance sheet stress remains very high. Infrastructure sector. Now, I stated right at the start that one of the big beneficiaries would be the investment-led growth that we expect would happen over the next 1 decade. Now, again, just like power sector, these companies also suffer from the twin problem of of balance sheet is highly stressed, whether it is GMR, Lanco, GVK. Every one of them has very high balance sheet. Some of the engineering companies like L&T also have very high balance sheet because their subsidiary has entered into the infrastructure business space, which has just tried to take up as much of debt as possible with very negative cash flows. And we do not like that kind of business model wherein the balance sheet is very highly stressed and the cash flow remains very crappy, because it means that the company would keep on being continue to be in a negative cycle of each year raising new and new debt in order to fund its existence, because its cash flows remain weak and they are not strong enough to even service its current debt. And because of that we do not like infrastructure sector. Just like the power space, we prefer over here again to go through the second derivatives of the investment thesis, that the infrastructure sector may see a boom rather than entering into through infrastructure. And what do we mean by that? We mean that one can look at entering into getting the benefit of infrastructure sector through metals and cement. For cement, the correlation is much more stronger than it is for the most metal companies. Why? Because cement continues to be a very localized industry. If there is a surplus in say the western part of India, it is not easy or economical for one to transfer say, his cement from western part of India to say the northern part of India at a very low cost. The cost of transport is very high, and because of that, and this tends to be a much more localized phenomenon. And because of this reason, the correlation in between the cement and the infrastructure boom happening in a particular area is a very strong one. The big benefit that you get out of cement is most of the cement companies, with few exceptions like India Cement, would have very strong balance sheet. They would have very low level of debt or very strong level of cash positions. uh, Second, when I'm saying cement, I'm speaking about the top 7 to 8 players, the smaller players still have very high balance sheet problem, but the top 7 to 8 players do not have that kind of a problem. Second, they have very strong cash flows. Uh, Over the last 15 years, one of the big things that the cement companies have tended to incorporate is that they have tended to put a very tight control on their working capital days. So most of the times you see cement companies would not tend to have more than 62 and 65 as their working capital days, which is very good, very phenomenal, especially given that cement is a very commodity kind of a space. And because of that, we tend to like cement. The only reason that we have not given any cement company in the report is that most of the companies tend to be highly valued as of now. But if we see any correction in the cement space, cement would be one of the big place where we would like to invest into. In Jan of 2014, we had suggested two cement companies, that is ACC and Shri Cement, as a possible investment avenues through which investor can capture that kind of benefit occurring to them. However, by March, most of the cement companies had moved up substantially, and we believe that it would be very imprudent on our part if we were to jump into cement as of now. If the cement companies were to correct because of any risk averse increasing in the market suddenly, we would be very interested into buying into certain cement companies. In the case of metals, when we say metals, we are largely looking at the zinc or the steel kind of a story. We are not looking at copper or aluminum, a global story, but we are looking at a much more localized story. Because if one of the big beneficiaries of infrastructure boom again is going to be steel, and companies that have most of their revenues coming in through the local or domestic businesses would be the big beneficiaries. And over here, one of the key people that we have seen have very strong balance sheet is Jindal Steel and Power Limited and SAIL, Steel Authority of India Limited. Now there are multiple things that are happening in Steel Authority of India Limited. One, by end of this financial year, that is 2013 and 2014, much of the expansion of SAIL is nearly finished. They have expanded their capacity from 50 million tons to 24 million tons. Much of this capacity is happening at the value added steel. Now one of the big differentiators in between the SAIL, that is Steel Authority of India Limited, and Tata Steel, historically has been that Tata Steel had been into a much more higher value added segment. It had a much more better cost structure than SAIL. We believe that the current capacity expansion would help in reducing that kind of competitive advantage that Tata Steel Tata Steel's domestic business has uh, uh, had for over last 10 years. We believe that SAIL would be one of the key beneficiaries of the coming boom, uh, given by the fact that it has balance debt on its balance sheet, but it continues to be at a very optimum level. And given the fact that much of its capex program is done, we believe that within next 12 months it would see much more increased cash flow that should help it in servicing those debt much more easily. The reason we did not give Tata Steel, even though on a valuation basis, Tata Steel is at a very attractive space, is because of one constraint, because of one big risk, that is we would like to see how its core side of the business does well. Tata Steel's domestic business would see a very good future, but we are very much concerned about the risk in its core side of the business. And given the fact that a major part of the Tata Steel debt has been raised in order to service its acquisition of Chorus. So the Chorus is the factor because of which we have not recommended Tata Steel. Otherwise, Tata Steel would also have been one of the key beneficiaries similar to SAIL. Henceforth, this is the reason that we prefer SAIL within the steel space rather than say Tata Steel, or rather than say Jindal Steel and Power Limited. So if you can go through a selective opportunities, then metals can be a very good space. In that, there are sometimes you come across some what we call a special investment cases like Hindustan Zinc Limited. Hindustan Zinc Limited is very arbitrage kind of a case, because at one side you have 65% ownership through of Hindustan Zinc by Vedanta, and on the other side you have nearly 22.5 percentage kind of a ownership by Government of India. Now Government of India has been working actively towards seeing through what way they can sell off this stake and raise somewhat close to 18,000 to 20,000 crores of rupees, so that the fiscal deficit gap can be bridged. Now, a lot of noise was made in the last 6 months uh, for Hindustan Zinc Limited, and an expectation was built in the market that such kind of disinvestment can happen by the end of February. But we thought that that would be too early, given the fact that by the end of over the last 6 months, one of the key things that one can clearly observe in the political space is that the current dispensation had lost all political will to execute a far-reaching and strategic kind of disinvestment taking place. However, even we were taken through this because the news what that was coming in was that instead of doing a strategic sale, the finance ministry were much more comfortable doing an auction route. Auction route would have been a much more positive for the small investors also, as it could have allowed even global metals and mining companies to bid for it. More importantly, it would have faced minimum resistance. It would have faced minimum opposition from any space, either bureaucracy, courts, or opposition parties, given the fact that it is an auction based selling. So one cannot could not have easily argued that a benefit was given to a certain party or not. So in however, we now think that Hindustan Zinc kind of a story can take place over the next 12 months, largely given with the fact that at some level, at least among the ministries, uh, whether it is Ministry of Finance, whether it is the Ministry of Metals, or whether it is Ministry of Law, there is an agreement that they would prefer an auction based route, which we think would be extremely beneficial for the shareholders, because this would allow participation by even global metals and mining company. And given the kind of business model that Hindustan Zinc Limited has developed under Vedanta, with a strong profit margins and a strong resource and exploration base, we think Hindustan Zinc Limited would be one of the key stories playing out over the next 12 months, even at current price levels. The oil and gas sector space. Now, one of the good decisions that has been taken by the government of India over the last 1 year is that they have allowed a monthly price escalation in the petrol and the diesel space to be done by the OMCs. This has allowed them to decrease their under recoveries. The under recoveries as of now are much lesser than what they would have been if this kind of adjustment would not have been allowed by the government. We believe that going forward, the new political dispensation would not change this kind of a policy. We also believe that by 2015-16 we may see a scenario wherein US itself may become a crude exporter rather than an importer of crude, and that would have a negative impact on all crude prices, and that is extremely beneficial for all oil and gas and private sector, sorry, public sector companies in India, including companies like Oil India and ONGC, because paradoxically, compared to most private as well as global companies, falling oil to some extent is good for companies like Oil India and ONGC, because it means that they have to carry lesser and lesser subsidy burden. uh, if prices are high, Oil India and ONGC have to carry much more higher subsidy burden, and therefore the benefit of the higher prices is not easily realized by them. But if the prices come down to by say another 10% or so, their subsidy burden decreases at a much more faster rate, and that allows them to enjoy much more better capital structure, that allows them to enjoy much more higher level of liquidity and cash flows. Uh, we believe that this is likely to happen over the next 2 years, driven with the fact that the new government will continue with this kind of policy of allowing a slow escalation so that the oil under recoveries fall down. Second, one of the big reasons that we like PSU companies is driven by the fact that we believe that the government would give much more higher level of autonomy and flexibility with respect to how a company can go ahead with this capital allocation decision. Now, most of the times, if a company in the PSU space, even if it is a Maharatna or Navratna company, if it had to take a capital allocation decision, most of the time it had to go to its specific ministry. So if it was oil and gas ministry, it would go to an oil ministry. If it was say thing like Steel Authority of India Limited, and it would go to heavy engineering and a kind of uh, ministry. If it was BHL, it will go to heavy engineering. And because of this delay at many a times, the companies have been very slow in responding to market requirements. This has resulted in some PSU companies at times losing out to their private counterparts in their expansion policy. We believe that this is likely to change. Uh, we would see more oversight by the respective ministries, but there would be much more freedom to PSU companies in their expansion policies. And companies like NMDC, Oil India Limited, who have strong asset base and strong exploration policy, they would be very key big beneficiaries. If, as we have stated in the report, if you look at Oil India Limited, just recently it had won a natural gas and a block in Myanmar. We believe that given its strong cash and liquidity on its balance sheet, that aspect is only going to expand post election as and as these companies get more autonomy. So if we prefer companies that have strong assets already in place with a strong balance sheet to support future growth. So these companies like Oil India, MRPL, or NMDC are the companies that we like very much in this particular sector. Now, this is a very unlikely category within the story, because our story till now has been that PSU companies, investment-led companies, manufacturing companies, these are the companies that are going to be the big beneficiaries. And now there are very specific companies within the consumption sector that we think would investors should have. When we say consumption stories, we are not looking at the HUL and the ITC of the world. We are looking at much more companies that have much more discretionary consumption pattern. These are like companies who are in an auto sector, companies who are in the white goods sector. These are the places wherein over last few quarters we have seen the demand really come down a lot, driven by the twin impact of low job growth and low salary growth for the youths, as well as very high level of interest rate driven by the inflation. We believe that over the next 12 months, both of at least one of these thing is definitely going to get addressed. That is the inflation and the interest rate side of the story. And as the manufacturing and the investment led boom starts in, we'll see more jobs and more salary growth happening. That should support another the discretionary kind of a consumption sector. Within this space, we tend to like companies like Bajaj, because these are the company. This is a company that has a very strong profit margin, strong and stable profit margin, which they have commanded even during the time space wherein its major cost, that was metal prices, were increasing at a very fast rate. Even in these spaces, in these years, and Bajaj has commanded a very strong profit margin, and it has very strong and a brand. It has a very strong and a product pipeline. Because of these all the reasons, we continue to like discretionary oriented consumption stories, as and when we can get them at a good enough prices. Now, with this, I would like to, over the last 1 month, uh, besides report, what we have been doing is that we have been running certain blog, certain uh, ideas of that were going behind our investment thesis through our stock shastra. This is the first time that we tried to do, in which over the period of 1 month we laid out whatever our investment thesis was for particular uh, uh, investment idea through a series of blocks. So we have done 4 blocks. I'll take you through those 4 blocks. The first block that we did on 21st of February was how will the economy evolve if BJP led coalition were to win in 2014 general election. Now the key idea in this block was what would happen if we were to see a very strong performance by BJP. It is still a coalition government, but we are expecting say close to 220 230 kind of seats on BJP itself. Um, Now, if that were to happen, we said that in a certain kind of things like PSU banks, disinvestment, public sector companies, energy-based companies, these were the companies that are going to be the big beneficiaries going forward. The second story that we ran about close to a week later, sorry, 2 weeks or a fortnight later, was how will economy evolve and stock market. We still are getting a BJP coalition in the second part of the uh, uh, probability based analysis that we are trying to do, but we are saying that instead of saying it to seeing say 210 to 230 kind of a story, what if BJP just languishes close to 165 to 180? That would mean that it would have to take more political support from parties like probably say TDP, Trinamool Congress, probably Biju Janata Dal, probably AIDMK or DMK, we do not know, but that would result in a similar kind of story as the previous one, but more a banded kind of solution rather than a comprehensive solution. So for example, when you said that banks can see a strong level of reforms happening in space, in the second side, while banks will see the balance sheet get more support from the government, but that's it. We would not see a global level of a fixed kind of a solution that would see to it that the kind of interference we saw in the last 5 6 years would not again get repeated. We will see a fixed kind of a solution wherein government may put its own money. It may help the PSU banks raise money through FPO route and use this to boost the balance sheet of the PSU bank, but that's about it. We would not see a strong overarching reform in the power sector, if in the banking sector, because the government would not have the political will to execute it. The third space was we said that it's too early to directly say that we can outrightly reject Congress as such, because in spite of what pollsters say, if you were to just make a cursory glance across India, you would realize that there's very few states where Congress does not exist organizationally. There are very few places where Congress can there are very few places from which Congress cannot get a substantial amount of vote, and that continues to remain a strong advantage for Congress, uh, because this would help Congress perform much better than what opinion polls may suggest, because it can, if it gets its act right together, it can really ensure a strong rural India's performance, and that might not necessarily work out for in the interest of the BJP or others, but it would definitely help Congress form a garner huge amount of seats. Now, if you look at BJP and Congress together, you would realize that it is much more easier for Congress to attract coalition partners than it is for BJP. So, for example, if Congress were to get 140 seats and BJP to get 160 seats, Congress is still in the game towards forming a government, a weak government, probably a government that Congress would probably more like to support from outside rather than being a part of it, but Congress would still be a part of that kind of a government. Today we did the fourth and the final part of the story, wherein we saw what if it's neither the BJP nor the Congress, but we see a third from federal from government, probably from supported from outside from by either Congress or BJP, or a minority government that is a third front federal front government. What would happen then? And on this basis we try to build up an expectation of how we should look at market as of today. Now please understand, these are the expectations that are very personal, as in these are my expectations, your expectations can be bit different, but there is a key thing that you run benefit that you get by running this kind of a expectation build up story. Now what I've tried to do over here, for each of the four possible scenarios, we have tried to identify at what level the Nifty could go. So this has been done largely based on the type of noise that we are hearing in the market. So if a third front government comes in, most of the foreign investors are going to panic a lot. They would think that the reforms that they were building up might not happen, and we can see a strong correction happening in market to say 5200 kind of scenario. That is our fourth that is our fourth scenario. If we see a Congress-led government, most of the people are going to expect that it is going to be a continuation of the same old 10-year story, and we should not build up too much of an optimistic expectation. And that is the third kind of scenario we have built in. The second kind of scenario is, yeah, you can expect a BJP-led government, but it is not necessarily going to be a very strong government. It may do some kind of reforms, but not necessarily too great reforms, not too epoch reforms, not to defining reforms. So that is our second scenario. And our first scenario was that what if we really see a strong center right party building up a coalition and coming into government, then we can expect a strong reform based on a government to play out. And on that basis, we had given, based on the noise that we were hearing in the market, what are the possible Nifty outcomes over the next say 12 to 14 months. So for 7800 for in the first scenario, 5200 on the extreme side of the second scenario. Now this is these numbers, these are generally what we see have heard in the market. You may have heard differently and you can play around with that, and these are the probabilities that are probably our probabilities. It may be biased with respect to how we see the things playing out. People may have other expectations. So for example, people who believe or who have good reason to believe that rather than BJP we would see a return of Congress-based government, they may probably want to allot a much more higher probability of say 50 or 75 percentage rate. The key to exercise is two part. One is to realize what probabilities you are giving for each of these kind of scenarios, and on second, what is the probability weighted fair value of Nifty that it is generating. These 2 points are very big key. The reason being, it tells you something very unique. Uh, it tells you that should you now if I were to take my example, now if market is let's say today at close to 6,700 and I am my expectation is coming down to let's say 6,875, it is trying to tell me that even with a very high level of bias wherein I am giving nearly 20 70 percentage of the benefit occurring to BJP, I am still saying that the market looks fairly valued for to me. So there are going to be very selective opportunities even for a person who is thinking that yes, it is going to be BJP-led government, it is going to be a reform-based and a orientation. There is a policy reset of some level going to happen. I am still that is still forcing me to say that I need to be a bit cautious. I should not go on my assumption of that the fact that it will go to 7,800, but go by the fact that because of the risk that exists to my scenario, mm, I should as of now expect that the market is nearly fairly valued. Now, yes, this kind of exercise would yield different results to different people because they would have different probabilities for the same kind of numbers also. But the key part over here is how are you expecting towards the market. It allows you to think not just in a linear direction of our bias towards the fact that like Chaitanya Kekre is expecting that BJP government will come in, so market is going to go to 7,800. Instead of being a bias towards one single scenario, it forces us to look on a probability basis as to what is the likely scenario and how much expectation of fair value should I be giving to the market. It allows us to be much more cautious and much more uh, it allows us to not to keep our head inside the sand but keep our head in the game and make a much more prudent decision that would help us into the future. With this, I would like to bring the end to our presentation, and I would like to take the questions that you have given to us through the chat window. The first question is by Shirish Shah. His question is, if I'm making 15% loss in Cesar Sterlite, can I shift to MRPL or sale at current price? You can shift to MRPL or sale, but I would say that even non-shifting would not hurt you that much because of the two. In fact, as I stated right in my presentation about natural resource sector, that the companies in the natural resource sector are going to see a much more beneficial outcome occurring to them. We would see more clarity. And one of the big reasons that Sesa Sterlite has been doing very bad for last 2 years has been that the natural resource clarity has not existed. So, for example, it's Vedanta the Aluminum Limited plant and continues to suffer from an availability of bauxite mine. We believe that once the new government comes in, that is something that can get cleared very fast. We do not believe that it would get probably in the mines that it had planned initially when it had come up with the plant, but it had bought a license from L&T's Raikal aluminum project which never took off, but which still has a very strong which still has a strong area that has a very huge reserves that could still work out for an Sesa Sterlite. And the big thing, we expect that the Karnataka based format of an exploration that was allowed by Supreme Court in for an private iron ore miners would be something that would be used again by the Supreme Court in Goa. So it is just probably end somewhere close to Diwali or so. You should see the results from Supreme Court coming in, allowing an exploration, allowing export of iron ore as well as allowing an extraction of iron ore, and that should be hugely beneficial for Sesa Goa. And I don't think that you need to shift from Sesa Goa to MRPL or sale just to gives you a psychological benefit of the fact that you have recovered your 15%. I think once the Goa based results come in, Sesa Goa can do actually very well because a huge part of its asset that is non-performing of its today would become performing, and that would usually add to its bottom line and its top line. Uh, The next question is from Rajiv. What about Adani Group stocks? Can we buy even now because of Modi government expectation? See, Rajiv, one of the key theses and which we clearly wanted to be careful about was not to buy into companies that have very overtly known connections with respect to one of the political parties. So well, this forced us not to look at Adani's. This also forced us not to look at Jindal's. So even though when I stated my case for sale, we did not look at Jindal because political risk is the key thesis of this. And see, if the BJP kind of a story does not plays out, even if let's say the second story plays out that the BJP does comes, but it comes through a very weak government, then we can see a big correction happening in stocks like Adani, which has already ramped up by about 100% or more or so. So that is a very big risk for cases like Adani. And if let's say the first one plays out and BJP does comes in, Modi does becomes a prime minister, the ease with which Modi could have Adani's could have got benefited when Modi was a chief minister, it would not be so easy for an Adani to get similar kind of benefit just because Modi becomes a prime minister, because a scrutiny that has increased over the last 24 months and especially after the RTI has increased tremendously. We do not believe that fundamentally speaking Adani would be a huge beneficiary. There are two negatives that has happened on Adani that may probably go away. One is related to its Adani ports and SEZ Limited. Therein the problems on the environmental side wherein it first got clearance, then its environmental license was revoked because of protests happening from a certain fishermen around that area. We believe that kind of cases may die down. The government may see to it that these kind of things do not happen, for a simple reason that for a infrastructure and a manufacturing led story, port led growth is going to be very critical. Port led growth is going to be very critical because we believe that export oriented, manufacturing oriented story is going to be the key for over the next 10 years for India, because India would try and learns a certain aspects that China had done. And we believe that Adani ports may be a beneficiary, but overall Adani stocks I would be a bit skeptical because much of the upside has already been factored in, and even if the second scenario were to play out, it would be very big negative for a company is in the Adani group. The next question is by Mr. Nilesh. His question: what about FMCG sector? Is it attractive at this level? Uh, See, the good part of the cases like FMCG sector is that they would also be the beneficiaries if the job-led growth does happens. But when we look at the valuations of many of these FMCG companies, they tend to be at a very high premium levels. They have not yet come and corrected to extent either on a valuation basis. So I'm not saying necessarily on a stock price basis, but I'm saying more on valuation basis. For example, if ITC would have corrected at a PE level of close to say 22 to somewhere close to 25, we would have been very interested in a case like ITC. However, it still continues to be at a very high level of close to 30s, and that is the reason that we are a bit skeptical into investing into FMCG defensive kind of stories. Uh, I if we get FMCG kind of companies at a very good valuation levels, we would be interested because yes, job-led growth would be beneficiary to them also, not necessarily to that extent as it would be for capital and capex oriented companies, but yes, it would be beneficiary to them also. But that we believe at a very high valuation level is now already been factored in, so that's why we would tend to avoid them. Second, I would like to point out one key risk that FMCG companies are running now. If you, we have been tracking how the disposable, sorry, how the income levels have been moving around for the urban India and rural India on an average. Now, one of the big threats for FMCG or key risk for FMCG companies is that the rural India income, even though it is increasing in the real terms, in the nominal terms, it's the real level growth has fallen down drastically over last 2 years. It has come, real level growth has come down to 1%, 2% kind of level, and that we believe is very big risk for even for Congress giving a very low level of an getting a very low level of seats even in rural India, because the rural led and income growth has not kept pace at a real level as much as the nominal number looks like. So if you see, most polls would say that price rise generally is the dominant and aspect that voters are looking at, even if whether it is urban or rural, whether it is in the North India or the South India. So that is one thing because of which I would like to avoid FMCG companies for now. The next question is by Rajiv K. What about power sector stocks, PFC? Uh, Rajiv, as I stated, we have already recommended PFC. We would be very positive in PFC because it has very strong asset. It has very strong NIMS. It has very strong capital adequacy ratio. Very low level of NPS. We like both PFCs as well as REC as of now. The next question, follow-up question by Rajiv is there an expectation that power sector stocks to boom in 2015? Will you tell any attractive stocks? Uh, I'll highlight the risk first. While yes, power sector stocks can do extremely well, but they would do at a very high level of risk. So they have very high level of balance sheet stress. They are many of the power sector companies still have very active plans of expansion, which means that they'll continue to have debt as well as they will continue to make low level of cash flows to service those debt. So if you are okay with that kind of a risk, then you can look at companies like Tata Power, Adani Power, as well as say Torrent Power. Out of this, we prefer Tata Power and Torrent. The case for Torrent is because among the power companies, the stress is very low. It has very strong and it has one of the best manufacturing units in power sector as such. Most of its plants are Siemens plants. Second, its major problem because of which it has not been doing well is largely driven by the fact of availability of natural gas. We believe that once the natural gas starts flowing in over the next 12 to 18 months, because both ONGC and GSPL are also expected to start the production over the ONGC, I think, has already started its production, but it is going to ramp up its production over the next 12 months. And GSPL is also going to start its own production from the KG-D6 basin. We believe that Torrent will do actually much better than most of the power sector other company. Then on a risk reward basis, Torrent may do much better. But if you're okay with that kind of risk, yeah, you can look at select power companies like Reliance Power at around the price level of 60. It is very attractive. Torrent Power at the price level of 90. It is very attractive. Um, Just but most of stock recommendations are from the government companies than on the private companies. As the government stocks moves up very slow, whereas any negative news for this company brings the stock down twice the up move. Can you please elaborate on this? Jayesh Patel, one of the big reasons why this was happening over the last 5 years, if you look at all the PSU stocks as a group, whether it is in the banking space, whether it is in the capital goods space, or whether it is in the power sector space, is because of the fact that it was getting the negative rub off with the fact that government itself was been very slow in taking crucial decisions. So if you look at companies like NMDC, very strong balance sheet, very strong cash flows, very strong profit margins, very good expansion policy, but most of the market was not looking at it. We believe that that is likely to change given by the fact that, as we said in our thesis itself, that the big thing that is likely to happen going forward is that you should expect that most of the strong large PSU companies are going to get much more higher level of autonomy than what they are getting today. This in its own is going to put PSU sector at par with the way they have been rated with respect to their private sector competitors, and we believe that this all gives a much more better risk reward scenario than the private sector players. And this, we believe that over a period of next 5 to 6 years, you may see the gap in between the private sector players and the public sector players narrow down a bit. If you remember, remember the way GSFC was, the way Gujarat Alkali was, the way GSPL was, even though GSPL was not listed, but as a company, the way it was, of the way Gujarat Narmada Fertilizer Company was. At the start of 2002 and the way they were around 2000, they are right now at, you would understand the different stark difference that had happened because of the policy reforms brought in by the state government. We believe that kind of similar policy reforms will happen for the large PSU players who have a strong they may either see one of the two things. They may either see strategic disinvestment happening for them, or they may either see an more autonomy and much more expansion happening to them. That we believe would be very attractive to the market, given the fact that many of these companies remain very conservative, have very strong balance sheet, and hence very strong in capital employed returns. The next question is by Mr. Pawan Agrawal. Sir, are you expecting any fall before election results? Uh, Key thing that you need to keep tracking is, as I did this exercise, uh, that is of saying that there's a good likelihood that based on my probability based expectation, I see market to be nearly fairly valued. Now if you do your kind of exercise also, and let's say you also arrive at the similar conclusion, uh, the thing that you need to realize is that there is not necessarily too much of a upside in entering into a space in the at a market at a on a blind faith basis. You may find selective opportunities, but you should be open to the fact that you can see a strong 10-15% correction, because market is nearly fairly valued, and it is now effectively valuing or assuming that we are some level seeing a strong reformist government coming. If that does not happen, you can see a immediate correction happening. Can it happen post poll? I think there is a good likelihood of that happening. Can it happen pre poll? I would tend to follow how the marketplace is going to how the marketplace is going to look at the likelihood of the first scenario or the second scenario to play out. Any negative expectation that market develops in this would see a very drastic correction, because one of the key reasons that the because of which market moved to these kind of levels post the the December election results was because market had inherently started assuming that we are going to see a BJP led government take center stage after the general election. Because of this, I would assume that you need to factor in that 5 to 10% of correction can happen. Use that kind of a correction to buy into those kind of select stocks that we have recommended, and that would work extremely well. Do some select investment opportunities exist? I do think they exist, but be as careful as possible, because we believe at some level that the market is nearly fairly valued, and generally our backtesting shows that whenever we have come to a quantitative analysis of saying that the market is nearly fairly valued, we have seen a correction happening and a post and a market reaching those kind of levels. Uh, with this, I would like to bring the subscriber webinar to an end. The video webinar of this, the link of the video webinar of this particular webinar would be emailed to everyone who had who had registered for this webinar. If you have any last question, please let me know. Else, I would like to bring this session to close. Okay. With this, we would like to bring this session to a close. If you have any further question, please feel free to contact us through the customer care. We will be highly delighted to take any of your queries. And I welcome you all to the Money Works for Me family. Those of you who are new, uh, if any one of you wants to know in much detail how to use our website, please feel free to contact our customer care and request them for a demo, so that they can help you in understanding our thought process as well as our website very well, so that you can derive the maximum benefit out of it. Thank you very much for joining us for this particular session.